If you follow metals, macro, or frankly anything tied to global liquidity, you need to pay attention to what just happened in silver. I'm serious. This isn't background noise. Silver just exploded nearly 9% in a single session, clawing its way back toward about $86 an ounce only days after one of the most brutal collapses the market's seen in modern trading. Think about that for a second. A 27% wipeout. Then another drop. And now, a surge. So what is this? A bottom? A trap? Or the kind of mechanical reset that quietly sets up the next major move? Stay with me, because I'm going to show you not just what happened, but how to recognize this exact pattern the next time it appears. And if you're in markets long enough, it will. Before I explain what caused this whiplash, let me teach you something most people never fully grasp about fast markets. Prices don't always move because investors suddenly change their minds about value. Sometimes prices move because traders are forced to act. That's critical. Forced selling is very different from voluntary selling. Think of it like a crowded theater where someone yells fire. Not everyone runs because they saw flames. They run because everyone else is running. The exit gets narrow. People stumble. Panic feeds panic. Same thing happens in leverage markets when the pressure builds. Here's what you need to know about futures markets. They run on margin, borrowed exposure. When volatility spikes, exchanges raise margin requirements, and suddenly traders must post more cash immediately or liquidate. There's no debate, no waiting. No, let me think about it. Just sell. And here's the thing. That selling has nothing to do with whether silver's fundamentally worth $80 or $120. It's mechanical. It's forced. It's pure survival. So, when you see these violent moves, your first question shouldn't be what changed about the asset. It should be who's being forced out, because that's where the real story lives. Now, here's what's actually happening beneath the surface. Last week's crash wasn't purely about fear. It was mechanical pressure stacking on mechanical pressure. Let me break down the sequence so you can spot it next time. First, silver had been running hot. Positioning was crowded. Everyone and their cousin was long. When the initial drop hit, volatility surged. The VIX for metals went ballistic. Exchanges responded by raising margin requirements. That's the primary driver. Think of it as the house saying, hey, this table just got riskier. You need to put up more chips to stay in the game. Perfectly rational from the exchange's perspective. They're protecting the system. But for traders, it's a punch to the gut. Second, leveraged traders couldn't meet those higher collateral demands, so they unwound positions fast. They had to. That forced liquidation pushed prices even lower, which triggered stop losses, which triggered more margin calls. That's your secondary confirmation, the cascade effect. One domino hits the next. Price drops, margin requirements rise again, more forced selling, price drops further. It's a feedback loop that feeds on itself until something breaks the cycle. Here's what's wild about this. Markets often overshoot during forced liquidations because price becomes completely disconnected from conviction. Nobody's asking, is silver worth this? They're asking, what can I sell right now that has liquidity? They're dumping whatever they can to raise cash. Gold, silver, treasury futures, doesn't matter. Just get liquid, just survive. Value doesn't enter the equation, then comes the convergence. Once the weakest hands are flushed out, selling pressure exhausts itself. There are no more forced sellers left. The margin calls have been met, or the positions have been closed. And when there are no more panic sellers, buyers step in aggressively. Not because they're euphoric, not because they suddenly love silver more than they did 3 days ago, but because prices finally look asymmetric. Risk-reward tilts. Smart money that was sitting on cash sees opportunity in the wreckage. But here's the part that should make you nervous. Relief rallies born from mechanical resets can be violent, convincing, and temporary. The easing of margin pressure doesn't automatically mean risk appetite has returned to the market. It just means the tourniquet stopped tightening, the bleeding stopped. But that doesn't mean the patient's healthy. It means they're stable. There's a difference. So, now let me show you what most people are missing. The speed of this rebound tells you dip buyers were waiting. Capital was on the sidelines. Dry powder was ready. That matters. Because if this was purely exhaustion with no underlying demand, you'd see a slow grind higher, not a 9% rocket in one session. This kind of velocity suggests real buyers stepped in with size. If this is making sense so far, drop a comment and let me know where you're watching from. I want to know who's paying attention to this stuff. This is the exact same playbook markets have run before. Zoom out and you see it clearly. It's not new, it's not unique, it's pattern recognition. Think back to March 2020, the liquidity shock. Remember what happened to gold and silver? They plunged. Not because the fundamental case for precious metals got worse. Central banks were about to print trillions, but funds sold whatever they could to raise cash. Margin calls hit everywhere. Redemptions poured in. So they dumped metals, quality bonds, everything liquid. Silver dropped from $18 to $12 in days. Then what happened? Once central bank liquidity stabilized the system, metals rocketed higher. Silver went from 12 to nearly 30 in months. Same pattern. Forced selling, exhaustion, violent rebound, or go back to 2011. Silver spiked to nearly $50, then crashed. The CME raised margin requirements 5 times in 2 weeks. 5 times. Each hike forced more traders out. Leveraged longs got obliterated. Silver collapsed from 50 to 35, then kept falling. It looked apocalyptic in the moment. People screamed manipulation. But it was largely structural. Margin policy was tightening into a crowded trade. Eventually, the forced selling exhausted, and you got reflex bounces that were sharp and fast, even if they didn't stick. Even more recently, look at the nickel chaos in 2022. A short squeeze forced prices up over $100,000 a ton. The London Metal Exchange literally stopped trading and canceled trades. When they reopened, forced unwinds distorted price far beyond any fundamental reality. It was pure mechanics, pure pressure release. Every time this combination appears, crowded positioning, leverage, margin hikes, liquidation, you get exaggerated downside, followed by reflex upside. The magnitude changes, the timeline changes. But the sequence, it rhymes. Now, before we go further, let me be skeptical for a moment, because I want you to hear independent thinking, not just hype. Could this rally fail? Absolutely. Reflex bounces often retrace if macro conditions tighten again. If the dollar rips higher, if real yields spike, if tariff tensions escalate further, silver could roll over. We've seen it before. And let me be honest, silver is notoriously volatile. It's a thin market compared to gold. It whipsaws. Some people will immediately claim manipulation. Here's the thing about those claims. They distract you from the mechanics you can actually observe. Whether someone with deep pockets intentionally pushed the market doesn't change how you should respond to price action. You can't control that. You can control how you position, how much leverage you use, and whether you panic or think clearly. Focus on what you can control. Positioning awareness, leverage discipline, emotional management. That's your edge, not conspiracy theories. There are probably 3 types of people watching this right now. Some of you sold into the panic. Maybe you were holding physical, maybe futures, maybe minors. Maybe it hurt. Maybe you're staring at this 9% rebound, wondering if you made a mistake. Let me say this clearly. Surviving matters more than catching every bounce. Your job isn't perfection, it's longevity. If you sold and you can sleep at night, that was the right trade for you. What you want to study now is whether forced selling has truly cleared. Are margin requirements stabilizing? Is volatility compressing? If yes, maybe the coast is clearing. If no, you might have dodged another leg down. Others of you bought the dip. You stepped in when everyone else was panicking. You saw silver in the mid-70s and thought, that's absurd, and you pulled the trigger. That takes nerve. I respect that. But now you need a plan. Are you trading a bounce or investing in a trend? Because those are completely different mindsets, and confusion there is where profits evaporate. If you're trading, set your exit. Take profits into strength. If you're investing, ignore the noise and focus on whether the fundamental thesis still holds. Don't let a good entry turn into a bad hold because you didn't define your time frame. And then there's a third group. You stayed out. You watched the chaos from the sidelines. Honestly, that's a position too. Patience is underrated in environments like this. If volatility remains elevated, opportunities will keep appearing. You don't have to catch the exact bottom. You just need to be ready when the setup gets clear. The universal principle for all of you is simple. Learn to identify when price is being pushed by emotion versus obligation. Obligation moves markets faster. Forced selling creates crashes. Forced buying creates squeezes. Both are mechanical. Both create opportunity if you understand what's happening. So here's what I want you to answer in the comments. Which type are you? Did you sell buy or sit out? And what's your plan from here? I'm genuinely curious how you're thinking about this. Here's where I stand. I'm not calling this a new bull leg yet, and I'm definitely not dismissing it as noise. I think this was structural, a liquidation reset, not random chaos, not purely fear-driven. The mechanics were clear. Margin pressure built, forced selling cascaded, exhaustion hit, buyers stepped in. That's observable. That's data. So, what am I watching now? Let me tell you what I'm personally monitoring. First, I'm watching margin policy. If requirements stabilize or even come down, that tells me forced selling is likely behind us. If exchanges keep hiking, we could get another round. Second, I'm watching volatility. Does it compress, signaling the market's finding balance? Or does it expand again, meaning we're not done shaking out? Third, I'm monitoring follow-through buying. Real bull moves don't just bounce once and fade. They build. They attract fresh capital. They make higher lows. If silver can hold above 80 and start building support, that's constructive. If it rolls over in the next few sessions, this was just a reflex. Based on my analysis, this crash and rebound were mechanical, not emotional. The underlying narratives around silver haven't vanished. Industrial demand for solar, EVs, defense tech, that's still real. Monetary concerns about fiat currency stability, central bank policy, deficit spending, those haven't disappeared. The fundamentals didn't change. What changed was leverage and positioning got flushed. If history rhymes and silver consolidates here, rather than collapsing again, the move that follows could be significant. I'm not making predictions. I'm saying the pattern suggests we just went through a clearing event, and clearing events often precede the next trending phase. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the data yourself. Think independently. But if you made it this far, you're the kind of person who wants to understand markets, not just react to headlines. That mentality will serve you well. If this breakdown helped you see the structure behind the chaos, share it with someone who needs to hear it. Subscribe if you want more pattern recognition and market education. And stay sharp out there. Think critically. Watch the mechanics. And make your own decisions, because in markets like this, the prepared investor is usually